Hey everyone, welcome to our Phillip Securities Research morning call. For today, we have quite a lot of results updates and also usual technical pulse as well as our Singapore weekly. So this is our usual disclaimer. The information provided is solely for education purposes and should not be considered as financial advice. So with that, I'll hand over time to Hashim to get us started with Lendlease REIT. Thanks.
Thanks, Zain. Yeah, I'll go through Lendlease results. Next slide. So overall, Lendlease had a strong set of results. Gross revenue was up. Distributable income was also up over 20%. They had strong rental reversion and committed occupancy. Their reversion was close to 12%. Reason they were doing well is because their retail segment is doing well. So tenant sales, excluding PLQ Mall, is up 4%. Visitations was also up single digits. So if you include PLQ Mall, they are up double digits. So F&B, sports and jewelry did well. Gift and ancillary did not do as well. Overall, cost of debt also went down about 71 bips year on year. They extended their debt maturity to 2.8 years and there's no substantial refinancing. For negative, they own an office asset in Milan, Italy called Milan Building 3. It has about 51% occupancy. They plan to sell this building, but they want to lease this building up before selling. They haven't made much progress in the leasing front. Next rent review for the asset is in April 2027. Outlook-wise, PLQ Mall has about 16,000 square feet of space, level 1 and 2, that's being reconfigured. This was previously occupied by H&M, Uniqlo and Foot Locker. So once they reconfigure this space, it can be let out to tenants at high teens rental reversion, and it will be ready by December. And the multifunctional event space, it's also on track to complete by December this year, and cash contribution will start shortly after. So Lendlease has a TP of 77 cents and a dividend yield of 6.89%. Next slide. So next I'll go through Elite UK REIT update. Next slide. So overall, strong or stable operational performance from Elite. Elite acquired 3 assets at the end of 1H25 last year. So Customs House, TY Merlin and Priory Court, contributing 2.2% of GRI. So that helped with your gross revenue increment. Distributable income rose 3.6% from the lower finance costs. They are also acquiring 5 assets, 5 new assets that's contributing about 2.6 million in annual rent. They are purchasing it for close to 32 million, which is below independent valuation of the assets. So 4 of the assets is on CPI link review. 1 of the assets is on open market review. Elite also has a strong balance sheet. Net gearing fell close to 6.1% because they paid back close to 27.3 million in net debt. We expect the net gearing to go up towards the 35 to 40 range as debt will be drawn for acquisition and distribution purpose. So refinancing is also underway for a portion of the debt, and they extended another portion of the debt for 2 years to 2029. So there's still 30% of DWP leases that's expiring that hasn't been regeared. We're expecting about 15% to be regeared. Then the remaining 15% of the assets will be likely repositioned to either PBSA or co-living assets. The Lindsay House PBSA conversion is targeting 2027 with a 98% occupancy. So we have a buy on Elite with an unchanged TP of 41 pence, and it has a yield of 9.6%. Next slide. So next, Nordic Group results. So revenue was up about 2.8%, mainly because the maintenance services business contributed a larger portion. So it grew 4.2% year on year. And their PATMI was also boosted by lower finance costs and FX loss. They have won new contracts. So order book has grown to 254 million. Majority is in maintenance with another 40 or so % in project. Majority of the new contracts are in marine, offshore, defense, and semiconductor industries. They have a net cash of 10.2 million. They already paid back 2 loan facilities, but they did take up invoice financing, which rose sharply. They have operations in Thailand called AV Tools Thailand. So this is them producing brackets and structure for battery storage. So the customer is a green energy player. So that got a 1 month delay because of Chinese export control screening for their imported products. Now commission is targeted for first week of September, and full ramp of the operations is expected second quarter of 2027. Once they ramp it up fully, annual revenue contribution will be for about 20 million per year from AV Tools Thailand. So looking forward, Nordic is Micron's anchor in-house subcontractor. Micron is growing substantially. They are constructing double-level clean room and 25 million tooling upgrade. And as an anchor in-house subcontractor, Nordic will grow with Micron. The Changi Tengah Air Base is sized at 80 to 100 million opportunity. So that Changi is already awarded. Tengah is going to be awarded next year. Once these are awarded and completed, Paya Lebar decommissioning contract will follow. So that's also a sizable opportunity. We think a special dividend is possible for FY26 if they set a record profit. For reference, they paid about 15 cents in FY21 and 25 cents in FY20 in special dividends. So we have a buy on Nordic with an unchanged TP of 68 cents, and it's trading at a PE of 9.9 times. Next slide. So next, I'll go through Ultragreen.ai result. So overall, strong results. Revenue rose 30.7%. Their net profit or PATMI, adjusting for FX and discontinued operations, rose 23.4%. So this increase was primarily pricing driven. So they increased the price of their US vials in third quarter of 25. And now they are seeing the benefit of a full half revenue impact. And they're also aggressively growing their rest of world vial volumes. So this includes your EMEA as well as your APAC volumes. So both of them have had double-digit volume growth, as you can see in the table below. They do not have any debt on their balance sheet. They have about $139 million in cash that has been put into different instruments to earn interest. So this includes your corporate note, your money market funds, and they're trying to earn interest income, substantial interest income from this unused cash. Regulatory progress has also been made, so they have qualified second API suppliers manufacturing, and Perfusion Works, which is their data platform. It has already received qualification for EU MDR approval, and next will be US FDA approval. So negative-wise, OPEX increased 66%, but this is because they've been ramping up headcount. So headcount increased from 73 to 112 people. And this increase is because they are building up their data platform. Going forward, we expect this headcount increase to be stable. They also have $1.5 million in employee stock expense. So outlook-wise, growth is going to come from the 4 key procedures: cholecystectomy, colorectal surgery, breast SLN mapping, and your breast reconstruction. And this is a addressable market of 12.1 million procedures. So we have a buy on them with a TP of $1.91, and it's trading at a PE of 16 times, 16.4 times. So next, I'll go through Darren's results because it's not around. First, I'll go through Prime US REIT. So Prime US REIT overall revenue dipped incrementally. Distributable income dipped about 33%. Positives wise, the occupancy is up for 5th straight quarter. So it's up about 1 percentage point, and rental reversion is about 6.2%. Leverage wise and ICR wise, it's both stable quarter on quarter. So 44% or 45% in leverage. ICR is about 1.6 times. Cost of debt increased marginally to 5.5%, but we do see it being below 6% post refinancing. Occupancy is expected to exceed 85% by end 2026, and about 12% of your leases will start paying cash rent from third quarter 2026. And the US office market leasing is showing recovery. So leasing is up, transactions are up substantially, close to 32% year on year. So we've trimmed the TP to 25 cents, and it's trading at a FY26 dividend yield of 6.2%. So next, I'll go through Stonework Europe Staple Trust results. So overall, revenue dipped about 2.2%, but this is because they sold away assets. So they divested assets and their contribution reduced. And distributable income is still up marginally, about 0.3%. So for them, logistics and light industrial is driving their performance. So occupancy is up about 0.9%, and the rental reversion is close to 10%. So they have 90% of their debt hedged. So if there is going to be any further ECB rate hikes, we think they will not be substantially affected by it. And net gearing also improved from 42 to close to 41%, and they are targeting about 40% in gearing. In terms of exposure to logistics and light industrials, they are targeting 80% exposure, and this is by 2028. And a potential re-rating catalyst could be your management fee change or your management internalization. We have TP unchanged at €1.89, and it's trading at a FY26 dividend yield of 8.6%. So next, I'll go through CapitaLand investment. So for CapitaLand investment, revenue dipped slightly, and overall PATMI is up 14%. So CapitaLand investment fee income was up about 20%. And the main reason is because event-driven fees spiked from 6 million to close to 87 million. So that drove the 14% rise in PATMI. Negative-wise, net gearing edged up from 0.41 times to 0.45 times. So we think there's an embedded value in their non-core assets. So they have about $7 to $9 billion, two-thirds of which is in China. So the China Commercial Private REIT was listed 11th of August, and second C-REIT listing is targeted for the second half of 2026. The funds under management grew to 128 billion, and we expect fee growth to continue in the second half of 2026. So we have an unchanged TP of $3.69 for CLI. So lastly, I'll go through city developments results. So overall results was very strong. So gross revenue was up about 61%. So this was because the revenue from their property development rose about 166% year on year to 1.6 billion in the first half. And it was supported by the fully sold EC project, Lumin Grand. And so there's a strong property development. 352 units or 892 million was sold. And there's a 2,200 unit pipeline called Lumin Grand launching October 2026. So gearing wise, net gearing is up 75%. This is due to your Tanjong Rhu and Peck Hay Road land payments. So strategic review is complete and it's expected to be announced by end September. And they are looking to bring net gearing down to 60%. So divestment wise, potential divestments might include your legacy UK assets as well as your China commercial properties. Singapore property is resilient, so it has about 96% in 96 and 97% in occupancy for office and retail. So we have a buy on them with an unchanged TP of $11.32. So with that, I will pass on to the next speaker.
Thank you, Ashim. So next slide, please. Thank you. So Airbnb released a result, the second quarter of 2026, and revenue met our expectation, while the PATMI exceeded. Both revenue and PATMI met our expectation at 45% and 31% of our full year estimate. So it's not 50% because the remaining would be backloaded into the second half, as Airbnb is seasonal and the remaining quarters would be backloaded from the summer travel demand. So looking at the first positive point, we are seeing higher booking volume. Because of that, the revenue slightly beat consensus. The booking increased by 10%. So the rationale was because of the strength in the US market. which offset the booking cancellation in the East, Middle Eastern and Africa, which happened in the recent quarter because of the Middle East conflict. But it was better this quarter because of the broader rollout of the new initiative in the United States. So this include the reserve now and pay later with a zero upfront payment. So a lot of people book much earlier. There's also the FIFA World Cup, which was hosted in the 16 North American cities. So because it was hosted in the North American, which was 44% of the recent quarter revenues is material. Last reason is because AI making booking easier, because now they highlighted homes, hotels, and services that match the East guest preference. So this is one of the examples of how they make AI easier for the guests. So lead to the higher booking volume. Next positive point is that the average daily rate strengthened. If you look at the last 12-month average daily rates, it grew about 6.3%. So this number is the highest in the third quarter of 2022. The driver is in the largest market, which is North American. North American, although the growth is slightly smaller compared to the other region, but it's the biggest revenue, which is 44%, right? So the increase in ADR, although it's 7%, it matters more. So this driver was the price appreciation. Also because of the growth in the short-term stays, people are booking a lot of people are booking short-term stays compared to the longer-term stays, and short-term stays typically command a higher rates compared to the longer-term stays. There's also another initiative where they now shift from split fee structure to a single fee structure. Just now would be bear by the host only. So this increased the host pricing competitiveness and increase the price transparency for the guests. And they have already applied this to 50% of the active listing in the new structure. There's also Forex tailwind, it accounted for 1% of the ADR growth. For the outlook, we expect the full year revenue to rise by 13%. Major event pipeline would include Tour de France in July, NASCAR across the 2026, and then La Liga Spain. So as this event will drive more local listing and then higher booking activity across the whole cities. And there's also continuous growth from the emerging markets such as Latin America and APAC, and also the new initiative, which is the ABNB services. The new venture is currently expanding their offerings, including grocery delivery, car rentals, and resort pass. And then for the recommendation, we downgrade our recommendation from neutral to reduce due to the recent share price performance, because we think that share tends to rally then decrease in the weeks after for ABNB. But we raised also our DCF target price from 136 to 158 from the raising in the group terminal, because we think now that from the easing booking disruption in the EMEA and improving booking and ADR growth. But recent rally has pushed ABNB to a premium valuation. Now the ABNB is trading at 30.9 PE versus its 2 years historical plus one standard derivative of 29.6. So it's a bit overvalued. And then the APAC and Latin America growth is 2 times the mature market, but it remains small enough to offset the slowdown. And then the new business would remain immaterial unless for the next 3 to 5 years. That is all for ABNB. Next slide, please. Here. Next slide, please. Next is Palante. For Palante, the second quarter revenue met our expectation. Revenue and PATMI accounted for 47% and 56% of our full year estimate. PATMI exceeded. For the positive point, the US commercial business was outstanding. The growth surged to a record high of 110% year-over-year. This is much higher than 47% in the same quarter last year. So this is driven by the US commercial revenue, which was 150% higher than 93%. And then also we are seeing higher remaining deal value, which grew about 124%, much higher compared to the same quarter last year again. So this is continue to be driven by a strong enterprise adoption of AIP and sovereign AI. So the US commercial customer count also rose by 35%, and then supported by several large enterprises expansion. Next positive point is a strong government momentum. Government revenue grew about 79%, higher than 49% in the same quarter last year. So driven by the US region again. Growth was driven by the existing program and new contracts award, the expansion and the longer deal across the defense and the civil agencies. The government demand remains strong for us. It's supported by expanding marvel deployments and growing adoption of the Department of Defense. For the outlook, the guidance they reset by 7% for the revenue full year and 10% for the adjusted operating income. This full year is expected to grow 82%, supported by at least 134% in the US commercial revenue. So the current bottleneck for the Palante is the lack of the forward deploying engineers. So basically the software engineers that Palante send to enterprises to build the company's software, which is integrated with AI. So the company is currently spending higher amount to employ these FTE people. And if you pair this together with the higher backlog that is increasing, it should improve sales further in the next quarter. So we maintain a buy TP at 215. We raised our full year revenue and PATMI forecast following stronger than expected second quarter results, and we remain positive on Palante as the ontology and AIP is a kind of mode in the industry because not many enterprises are using their business model, sending FTE to build software integrated to their companies. And then if you pair with the accelerated enterprise AI adoption and spending, we are positive with Palante. That is all for me. I will hand over to the next presenter, Helena. Thank you.
Thank you, Fahmi. I'll continue with Disney. So for Disney, both their revenue and adjusted PATMI were in line with our expectation. Next slide, please. So experiences, which is the parks and attraction, it grew 10% year on year, and the growth was very broad-based. Global guests, domestic park attendance, and also people spending within the parks, all growing. So very resilient demand, especially when you consider the current macro uncertainty. And Disney continues to invest very heavily across its parks and cruise businesses. They have major expansion project underway in all its major parks, and they're opening up the Abu Dhabi Disneyland. And so far, it's very positive because so far we see all the recent addition that they have, including the new Disney Cruise Line in Singapore and also the World of Frozen at Disneyland Paris, all have been driving incremental growth right after they launch it. So very promising ahead. And when it comes to entertainment, their streaming side remains very healthy. And the theater they released Toy Story 5. It surpassed $1 billion at the global box office. And its franchise at the same time is also helping Disney to deliver its strongest customer product revenue growth in 20 quarters. So this is their strong IP flywheel in display. Franchises can be continuously monetized with so many different touch points, which is a structured advantage that nobody else can actually replicate. And when it comes to streaming, they're also starting to collaborate with TikTok. So now they allow people to use the Disney IP in TikTok video creation, and they will pick the highlight videos and they will show it some of the best ones on their Disney Plus platform. So their streaming is seeing increasing competition from short form video platform. So this is kind of their way to try to attract some of the users who watch short videos onto their streaming platform. So they hope that people use their streaming platform not just for watching long movies, but also for like daily interactions. But within Disney's competitive advantage still remains its IP ecosystem and its proven ability to repeatedly monetize old successful franchises across multiple platforms. And we see them continuing doing so in this quarter. And now with continued investment in their parks and cruises capacity to strengthen the overall ecosystem, we do believe they're well positioned to sustain long-term earnings growth. So we maintain a buy recommendation with a target price of $130. Moving on to my next company, which is Grab. So Grab's revenue was in line with our estimate. Their PATMI outperformed because they recently consolidated Superbank, so that gives them about $307 million gains. On the delivery side, their Grab Mart is emerging as the major growth driver. Their GMV growing at 1.7 times the rate of normal food delivery, and its user base is also expanding 42% year on year. Grab Mart is now still a very small part of their delivery service. It accounts for only 14% of the user base, so there's still substantial room for cross-selling and market penetration in this sector. When it comes to the finance services, their lending momentum still remains very strong. Gross loan portfolio reached 2.3 billion, which is up almost 200% year on year, and they expect the loan book to exceed $3 billion by year end. and they've recently consolidated Superbank, and they've also acquired Stash, which is a wealth platform. So these will also help broaden Grab's overall financial ecosystem and create additional cross-selling opportunities across these platforms. One alarming question for Grab right now is the rising fuel price. So Grab is trying to help by providing incentives to fuel-related driver support. The driver side actually deliver really strong, healthy supply. The average monthly active driver partners actually grew 19% year on year, which is a record high. Demand also very robust. Overall mobility transaction is up 28% year on year. However, what we're seeing is the customer, the way they're coping for the higher price is that they're actually increasingly opting for lower price riding options such as Saver. So that results in a moderation of the overall revenue growth to 12% year on year. And they commented that the fuel pressure is likely to persist. It's not going to impact their cost much because even the incentive they're giving right now, their incentive growth is similar as before. It's just the incentive is more targeted to fuel-related issues. But their revenue growth will definitely become lower if there's continued pressure. Guidance-wise, they've raised guidance because of the continued strength in their underlying business and also mainly because of the consolidation of Superbank and then Stash. We continue to view Grab as a long-term structural winner in the region, given its highly integrated ecosystem. Even for their ride-hailing, I mean, yes, right now there's a lot of pressure, but the demand is not lowered, and they're actually consider managing it pretty well. So we maintain our buy recommendation with a target price of $7. Moving on to the next company, which is Spotify. So Spotify, both revenue and PATMI were within expectations. Their revenue growth accelerated. It's driven mainly by strong premium revenue growth because in earlier this year, in February, they've increased their price for the US market by about 8%. And even doing so, their premium subscriber growth is still very resilient. So this is showing that they have very strong pricing power. They're the clear leader in the industry. So even if they increase the price, it's unlikely for their customers to switch to a cheaper substitute. And they're now trying to shift their focus towards improved monetization. Their MAU gains have always been strong, so that provides them with a very sizable base of free users, particularly among the emerging markets. So now they're trying to increase higher ad loads and also greater friction within the free tier to kind of drive premium conversion. So, which is what pushes up their next quarter guidance for the revenue. It's guided to grow at 17% year on year. Advertisement is another new highlight for them. Right now, the growth is very modest. It's only at 1.4% year on year, but they've actually just completed a 2-year advertising infrastructure overbuild. They're switching from the traditional sales to the automated channels like the Google ad right now. So they are expecting advertisement growth to inflect from now onwards, and they're expecting double-digit growth in the second half of this year. It's also going to support a gross margin expansion from the current 20% to 40% when it comes to advertisement over the long term. So Spotify, we're still seeing very strong pricing power and many monetization lever for them to pull at the moment. So we're still very confident in the business. We still have a buy recommendation with a target price of $650. Next company is Shopify. So both their revenue and PATMI exceeded our expectation because of stronger than expected GMV growth, broad-based merchant momentum, and continued strength in their merchant solutions, particularly Shopify Payment. So Shopify is a company that's benefiting a lot with the new AI trend. The traffic on agentic AI and also AI attributed orders both tripled year on year in this quarter. And we believe catalog could be a structural competitive advantage for Shopify right now because AI shopping gaining traction, and these AI agents they will be willing to interact with catalog because catalog is a very rich product data that Shopify keep track for all the merchants that selling product on its website. So this positions Shopify very well as agentic AI starts to reshape the product discovery and e-commerce industry. And another part that would benefit would be their payment system, because as AI agent and other channels, they create a more fragmented commerce environment. checkout convenience becomes increasingly valuable. And Shopify payment strength is it's able to manage very complex transaction flow into just one simple click from the customer. So that would be a whole lot easier for AI agent if they're trying to buy something on the client's behalf. It will make it so much easier. So this is also another area that they're gaining traction. So one shortcoming that we see is now a lot of their users are using Sidekick. So Sidekick is their AI personal assistant that kind of advise you on what changes you can do to your shop to generate better result. And because of this very, very rapid adoption, they're facing higher AI computing infrastructure costs. So that's creating near-term pressure on the margins. But we do think in the long term, it's still benefiting them if more people are using the AI to drive GMV growth. When it comes to outlook, they expect the third quarter revenue to increase by low 30s year on year. We increased our FY26 revenue and PAMI by 3% and 1% respectively to reflect the stronger than expected GMV growth. We do downgrade our recommendation from buy to accumulate due to the recent share price movement. Moving on to my last company. Sorry, too much content today. It's C Limited. So C Limited, their revenue exceeded expectations slightly due to their stronger than expected Shopee and Money growth. But PAMI was in line because they're facing elevated sales and marketing expense and also elevated provision for credit losses as they expand their credit business. So both weighted on the earnings. Their GMV grew 28% year on year, marking the 8th consecutive quarter of sequential growth. It's also support to increase the take rate further, and their Money further enhances its credit risk model. They're now combining with more external data, and its latest model now can improve their approval rate by 10% while maintaining the similar risk levels. They've also reduced their review time by 95%, which is a lot, by the help with AI. So all these allows them to expand even more aggressively. Their loan book grew 52% year on year, while their NPL ratio still remains very, very low at 1%. So one shortcoming that we see when it comes to C would be their gaming sector. It shows a slowdown. The revenue growth is still very strong, but their gaming revenue always has a bit of delay factor. So if you want to look at it more accurately, we usually look at their key operating matrix, which is the booking, the QAU, and the QPU. So all these three matrices are showing signs of slowdown when you compare it to previous quarters. Probably also because for gaming, every time they come up with a big collaboration with certain IP, it will drive up the demand. So we're gonna closely monitor for the next quarter to see whether the slowdown is actually real. So overall, we're still seeing very significant growth ahead, especially for Shopee and Money. We increased our FY26 revenue by 3% to account for the stronger than expected growth. And we also increased our sales and marketing expense and also the provision for credit loss by 5% and 3% respectively to account for the elevated cost. So overall, our target price did not change. It's still maintained at $170, and we still maintain the buy recommendation. That's all from me. I'll pass my time to Serena. Thank you.
Thanks, Helena. Good morning, everyone. I'm presenting second quarter result for Reddit and AppLovin. So let's start with Reddit. Next slide, please. Thanks. So the second quarter, PATMI grew 184% year on year to $253 million, and the revenue up 61% year on year to $805 million. This is driven by the strong ad growth in impression and pricing. So moving to a positive, the advertising revenue growth remained pretty robust at 64% year on year. It's driven by 40% increase in ad pricing because there is an improvement in full funnel ad performance, and the company see the conversion volume double on a year-on-year basis, and ad impression delivered also grew 17% year-on-year, and adoption of Reddit Max remain pretty strong among mid and lower funnel advertiser at the moment because the number of advertiser using Max has increased over 60%. And for Max revenue is growing more than 150% sequentially. And for key performance metrics, the global output actually increased 36% year on year. Now it's $6.20. But the company focus is more on the US side. So the US ARPU actually grew 51% year-on-year, and this is the 5th consecutive quarter of over 50% ARPU growth. So in this quarter, we also see a very strong financial profile for the company because adjusted EBITDA grew more than double to $343 million, and the adjusted EBITDA margin expand to 43% from 33% in the same quarter last year. Free cash flow also increased 2.5 times to $261 million. It's supported by the company still continue to have a very small, very capex light business model. Currently, it's around like $1 million, which is around like 0.2% of the revenue. For guidance, for the third quarter, the company guided a revenue in the range of $860 million to $870 million. They do expect adjusted EBITDA to increase 63 to 67%. to $385 million to $395 million, with the adjusted EBITDA margin of 45%. And despite the concern of increased traffic volatility, it's also dragging the post earning share price. We continue to see a strong monetization momentum in ad segment, because even for active user is growing at 18% year-on-year. For the advertiser side, the active advertiser also increased 70% year-on-year, alongside with the 40% increase in ad prices, and I mentioned it before. So at the same time, there's another metric, which is the new app user retention. It's also increased 50% year-on-year. Even now, it's still coming from a smaller base, but we view it positively because we do expect Reddit to have more development in order to have more engaged and sticky base of direct user over a long-term basis once the app user retention is getting increasing. So therefore, for Reddit, we have a buy rating. We also maintain the DCF target price of $230 because we didn't change any forecast. We do continue to expect the growth is coming from the scaling of Reddit Max and also resilient ARPU growth, and also continue to have a high margin data licensing deal with a company like OpenAI and Alphabet. Moving to AppLovin. Next slide, please. Next slide, please. Yeah, thanks. So the revenue for AppLovin, revenue up 53% year-on-year to $1.92 billion, and the PATMI increased 55% to $1.27 billion. This is driven by the improved model performance in gaming, and the consumer verticals continue to expand. So both revenue PATMI were at 49% of our forecast. And the advertising business growth slow, but it remained robust in the second quarter because the revenue grew 53% year-on-year to $1.92 billion, like I mentioned it. And the Max publisher earnings also recorded a double-digit growth, a sequential growth, so in the second quarter. But for AppLovin, gaming is still the main revenue contributors, but non-gaming consumer vertical, the company see the advertiser spend increase 28%, around 28%, compared to the seasonal peak in fourth quarter last year. And moving forward, the company will expand the focus to mid-market segment, and we are doing like partnership and also customer acquisition initiative because they would like to attract more advertiser in order to capture a higher ad spend across retail and e-commerce. But moving to the negative, we also see the free cash flow grow slow to 12% from 70% in the second quarter last year, because there is a 127% spike in R&D expenses because of a higher model training and inference costs. But for guidance, the company issue a total revenue range of $2.05 billion to $2.085 billion. It is implying that it will be a revenue growth rate of 46 to 48%. And they also expected the adjusted EBITDA to be in $1.71 billion to $1.74 billion, with the adjusted EBITDA margin target of 83%. And I saw the questions in the Q&A session about why the share price dropped post-earning. So it dropped 20% post-earning because the revenue actually missed the $1.93 billion revenue guidance, because there is a time gap between the AI models update, which kind of limited the sequential lift for advertisers spend and return in the second quarter. But management emphasized that because of this time gap, meaning that the model update is already live. So in the next quarter, there will be a major step up in the model performance. And therefore it will be driving the performance in the third quarter. And the company also mentions that there is a formal closure of SEC inquiry without any enforcement action. We also view it positively because it removes a very serious operational risks, including potential deplatform by the major platforms such as Meta and also Google. Therefore, for AppLovin, we maintain a buy rating, but we reduce our target price to $610 from $635 because while we keep our revenue forecast unchanged, we lower the PATMI by 2% because the company did mention that moving forward, they do expect a higher compute inference cost associated with model training. Yeah, and that's all from me. I'll pass the time to Glenn for SpaceX. Thanks.
Thanks, Serena. Yeah, so going to SpaceX, I guess the highly anticipated initiation for another Elon Musk company. Yeah, so we named it Prize for Mars Funded from Earth. Yeah. Next slide, please. Yeah, so brief company background for those who aren't familiar already with SpaceX. It's basically the world's largest commercial rocket launch provider and also the operator of Starlink, which is the largest satellite broadband network. It typically reports in three segments, is space, connectivity, and then AI. I'll go into more detail later. So it was listed on NASDAQ about 2 months ago in June, 12 June, and it's also listed as a SDR, Singapore Depository Receipt on 22nd July, so just recently last month. So for this SDR, some details, you can actually buy it under SGX, under the ticker UXSD. Yeah. So that's you can also buy Grab and C as well, alongside SpaceX as this part of their first tranche of the US SDRs. So it's a bit easier to I guess trade the SpaceX shares or even Grab and C shares, because it's in Sing dollar instead of USD. Yeah. Next slide, I'll go into the different segments. Yeah, I won't really run through a lot of their revenue and everything because there's not much change. So I think something that the people will be looking at is what do they actually sell, right? Like, what is SpaceX? So although the name says SpaceX, the space segment only makes up 22% of their revenue, of FY25 revenue. So you can see it's not really a space company as so much as it is a satellite company or even an AI company now. Yeah, they do have some rockets, right? A lot of them, and so for this Falcon 9 and the Falcon Heavy, they are reusable rockets. So this means that the first stage will actually be able to land and then refly. So this will cut the cost for them, right? For anybody that wants to fly into space, basically. And also, Dragon is also, I think, the only American vehicle that is certified to carry astronauts. And NASA is one of their customers. So a lot of it is based on governments. And also Starship, which is fully reusable. So I think that one is not yet put to public use. So that's the one that they want to have people go into space for they call it commercial space for anyone like you and me. If you have enough money, you can throw maybe a couple $100,000 to fly into space. Yeah. So the next segment is their connectivity segment. Next slide, yeah. So connectivity is the one that really helps, that makes the money for them. So connectivity is basically all their satellites. So they have Starlink Consumer, which is a satellite broadband. To simplify it, it's like your Wi-Fi or your internet, but it's based on satellites. So this has few positives. The main positive is that you don't need to have fiber optic cable like what we have now, right? We actually have although it's wireless, but we have a lot of optic cables running underground or in our buildings. In terms of Starlink, they don't need that, right? It's really just straight to the satellite. So you can actually put it anywhere in the world. So a lot of those more more suburban, not suburban, more in the in the middle of nowhere, those kind of areas, they need this because they don't have a wide fiber optic cable running through the whole desert. So that will help. Or even the other one would be for the defense, which they call Starshield, right? So those people, they need very secure, and also they might be in very like ulu places, so they really need this technology. So that's to sell for them. But the main downside for this is that it's very expensive because you are bouncing off. It's like using a satellite phone. Basically, you need a satellite in order to for every one of your broadband, and it goes direct. So that's the main downside for this, is the cost. And also the number of customers that they have is a shrinking pool. People are getting more and more urbanized, right? So they're moving into cities. And what if that comes, the less need for this, right? So they don't need to pay for such a high price for like a dish and a router, compared to you just sign up with like Singtel or Starhub, and it only costs you like $50 to $100 a month. Yeah, this one can run up into the thousands for them. So I think the main customers are still the defense and government. Yeah. Okay, and the last one, which is the newest one, the last segment and the newest segment, and the one that's actually spending the most money but contributing the least as of now, is the AI segment. So what is part of this AI segment is their Grok, which is their frontier AI model. So it's competing with the likes of GPT and Anthropic, Claude, Gemini, right? All these. So they are competing with these, competing directly with these LLMs. And it's mainly monetized through customer subscriptions. So similar to ChatGPT, Gemini, and also Claude. And then also APIs sold to businesses. And they also integrate it into the X, which is previously known as Twitter. Yeah. So and the last one, they also do some compute where they build very large data centers. So you look at this one here at the bottom, it's actually named, they call it Colossus, right? And it's originally meant to train Grok. But now what's happening is that they have a lot of access, so they are they do sell this access to other companies. So quite ironic that their main direct competitors like ChatGPT, Gemini, and Claude, right? They are also their customers. Yeah, so there's a bit of a circle of financing going on there as well. Yeah. So that's the three main segments. So I'll go straight into the investment thesis that we have, why. So we have a sell call, right? We initiated with a sell call with a target price of $75. The first one is that they have an unmatched launch capability, but makes up only a very small revenue line. So they are the dominant and the biggest launch provider globally, and they also have the reusable rockets. So it makes them very unique. But then again, the space segment is still very small in terms of the whole. You're talking globally, right? Not many people want to fly into space, or even governments, they don't want to just launch a rocket into space. So the revenue contribution is still very small, and it actually made an operating loss in FY25 as well. Yeah, the second investment thesis is that the Starlink, which is the basically the connectivity under the connectivity, the satellite, the broadband satellite, it's the main profit engine, and so the main reason that you want to own this stock, right? So it did continue to grow, at 50% year over year in FY25. But what we see, and what I've also said, is that we see this growth declining, because a lot of the high value rural customers that they are currently targeting will be very saturated, right? Almost everyone will own a Starlink by in a few years' time, right? Because they need it to connect to internet, and it will shift. Their mix will completely shift towards more of the emerging markets, the lower price ones, and also mobile users. So you're not going to pay like thousands of dollars for your mobile plan. So we see that coming down, and also the margins also come down. I think the main focus that they will have is just left the government, but there's also only so much room that they can grow in terms of defense and government. Yeah, the last one, which I think is the main reason why we have our sell call. Next. Yeah, it's the AI, right? So the AI segment carries the whole valuation of the company, right? You're looking at an IPO price of like $135, and even went up all the way to $200+. Yeah, and that's the main reason people are buying into this. But we don't see it actually doing anything or contributing to earnings at all. So it was loss making, and the biggest worry for AI is that they are spending a lot of money. Unlike the other competitors, you look at maybe not Claude, but you look at Gemini, and mainly Gemini. They are, while it's also burning money, but at least they have the ad business, right, to buffer that. But for for SpaceX, it's very similar to the worries that we have for Claude and also for Anthropic and OpenAI, right, where they are spending a lot of money and they don't really have a business, because their main business, which is Starlink and even the rocket launches, are not providing enough to offset the operating loss and the capex spend for the AI segment. Yeah. So that's why we have a sell call at target price of $75. And just to highlight that we are using a DCF, but our DCF, we had to push it to FY40, right? So usually we always do 5-year DCF, right? But even at the 5-year, we are still forecasting a loss. So we can't even have a DCF based on that. So we have to extend the forecast all the way to 14 years or FY40. And even then, we are still only able to get a target price of $75. Yeah. Yeah, so to carry on with that, they also released their results. And for the results wise, it is a bit positive, but it's still, we still maintain our sell with an unchanged target price of $75. The main positives are that they did manage to earn some cash, right, for the AI compute. And also, the connectivity is also shifting towards the enterprise and government, which is what I sort of foretold earlier, right, where they cannot focus so much on individual customers anymore because it's too expensive. So they're going now to the enterprise and government. But the main negative that we see is that one of their customers is now a fifth or 20% of their revenue. So they have a lot of risk there, right? Very heavy weighted to one customer. So if the customer, doesn't do well or just cuts spending, then they will face like a huge decline in revenue. And also the space segment is actually flying less now and is actually losing more money. Yeah, so that's another big worry that we have, mainly due to the launches dropping, and also a lot more R&D that they are spending into trying to make their reusable rocket more better, and I guess don't crash as much. Yeah. So for outlook, it hasn't changed much, but we do see that the capex will likely peak this year, right? And then the main thing is that we're looking at capex of 65 billion this year, right? Because they said that it will follow the second quarter in the third quarter and fourth quarter of this year, right? So second quarter they spent around 18 billion. So if you just simplify and forecast it, we're looking at around $65 billion of capex, and that is mainly paid off from the IPO that they did, right? So they managed to get a lot of funding from the IPO, and also they did that bond as well, which will help to cover the spending they're going to do in FY26. But even if we are assuming that capex falls in FY27 to like 40 billion, right? It will be very hard that they will be able to find this money again, unless they they issue another bond, or they can't do IPO already. So that will be the main question. And yeah, their share price did run up. Maybe I'll just answer this question since I'm on SpaceX. Someone asked why did their share price run up even though the share unlocked? So that's another worry for SpaceX investors, is that they have a projected share unlock, right, where the insiders can sell their shares at certain times, right? And the one that was recently was like last week, where a certain set of shares were unlocked. And I think the management did come out to say that, okay, I think the if I'm not wrong, it's the chairperson and the CFO or COO said that our tranches are due to unlock, but we won't be selling, right? So I think that helped to ease some worries and also maybe minimize that supply, that huge influx of supply into the market, which will lower the price. Yeah. And I mean, if you look at their second quarter results, it's a little bit more positive, I guess, on the AI front. So if you are very heavy in or you believe in the AI segment of SpaceX, then looking at the second quarter results, it's more positive, so I guess that's the reason why a lot of their investors, especially the Elon Musk supporters, right, would rush to try to buy their stock. But even at $140, it is way below the peak that they had of like 200 plus, and it's only few dollars above their IPO price. So it's not like a huge spike. It just recovered back to their IPO price. Yeah, but we are still quite negative on SpaceX. Target price of $75. Okay, yeah, hope that answers the question on SpaceX. Yeah, so now to the banks. Yeah, I think Ian also asked whether there's any update to the banks. Yeah, so here we go. We will cover three of the banking counters, and also SGX will be after that. Yeah, so firstly we'll go with DBS. Yeah, next slide please. So DBS, it came in slightly above our estimates, at 53%, mainly from the wealth and treasury customer sales, which was higher than expected, and it helped to offset the lower net interest income. The loans growth, looking at the positive, loans growth was quite healthy, 5%, and a lot of it was deal financing. So you're looking at like the Sembcorp, Singapore GLS projects, and also the short-term TMT lending in Taiwan. Deposits have continued to grow, so that's why you will see possibly some decline in the net interest margins, but net interest income still holding pretty stable, only down 2%. I think the main negative is that their income growth is now very geared towards equity markets, which is, it goes with the markets, right? So so it is the highest. The market's trading income is the highest since 2021. But the main risk is that if the equity markets stall, right, then this will also, this growth engine will also stall. So I think that's why they are continuing to try to build their wealth management fee income instead of depending on equity markets. Yeah, in terms of the outlook, their guidance has been raised, right? So that's positive, which is why we saw their share price run up quite a little bit more. They are expecting now that the FY26 total income will exceed FY25. Previously it was around, and also they raised their commercial book non-interest income, or simply say their fee income growth to mid-teens, right? And also deposit growth to high single digits. So all these are quite positive figures. Yeah, and they might give back some of their share buyback in terms of special dividends. So that might be something that we could look forward to in FY27. Yeah, so but I think it is pretty certain that what is a DPS that we're looking for DBS, right? In FY26, it will probably be $3, likely be $3.30. And then FY27, excluding that possible special dividend, we're looking at $3.54. So we are still assuming that 24-cent bump that they will give for end of year. So at the fourth quarter, or I think third quarter, they might probably announce or give some hints at whether or not they'll give that 24-cent annual increment to the base ordinary dividend per share. So we still we maintain our accumulate with a higher target price of $79, and we like DBS the most amongst the three banks because of its capital return plan, which they have forecasted all the way to FY27. Also, their fixed DPS policy, right? Unlike the other banks, are just giving this floating payout ratio. And also, they have shown very strong growth in their fees. I think they're one of the strongest, and their net interest income is also stable. Yeah. So for all these reasons, we like DBS the most. Even at their current price, right? They're still at the current, our forecasted DPS. They're still paying out dividend yield of around 4.2 to 4.3%. Yeah. So it's still the strongest amongst the three banks. Yeah. Next one, we have OCBC. So OCBC, yeah, next slide. Yeah, it's our second most liked, right? So in terms of ranking, we go DBS and OCBC second. So for the OCBC, it was also the earnings were a bit above our estimates, 53%, similar to DBS. Mainly, the main reason why earnings rose and it jumped by 22% was because of the trading income, right? Which is also a bit more volatile from customer inflow and the Great Eastern investment income. The second one is that wealth fees also rose by 44% to a new record of 470 million. And then this was also from a larger AUM base. And the last reason is that the insurance income also rose 68%, mainly from Great Eastern's margin expansion. Yeah. They have stuck to their dividend payout ratio of 50%. So it's only 47 cents and up 15%. Yeah, so that's the main positives. And the biggest negative would be that their net interest margin has kept falling, right? And the June's exit was 1.67%, right? And this is even lower than what we saw for the second quarter. So I think we will continue to see that falling at least for their net interest margins. But they are growing their treasury bill, so that's why they are able to maintain net interest income, only down 1% year-on-year, whereas margins have sort of crashed. For outlook wise, they have raised their loans growth guidance, so it's now high single digit to low double digit. They had a 7% year-to-date growth, but I think we will not expect the second quarter's pace will sort of continue. It will still be healthy, but not as fast because of a lot of it was M&A financing in the second quarter. Yeah. The rest of their guidance is maintained the same. Yeah, so why we like it, we maintain accumulate with a higher target price of $31.70. We like it because we do expect that the net interest margins will sort of stabilize in the second half, as they slows the treasury asset growth, and also, the SORA is also pretty flat now. It's even inching up a bit, and wealth will help to carry this the whole bottom line. They have also shifted the income mix. They have shifted from net interest income to non-interest income. And this is mainly, and the reason why we like it is because this is driven by customer volumes. So it's something that they can move rather than rates. Whereas rates is really by market, right? They can't shift rates. But for customer volume, they can push that, right? And they have been doing that quite aggressively by hiring a lot of RMs and expanding their centers. Yeah, so this will continue to grow. And the HSBC Indonesia deal will help to add onshore scale, from 2027 onwards. Yeah. So that's for OCBC. Sorry, excuse me. Yeah, the last bank we have is UOB. So, if DBS is first, OCBC is second, then UOB is our least like, right? In third position. Yeah, next slide. Yeah, so the second quarter earnings were within our estimates, right? It's the only bank that didn't exceed our estimates, I guess. The earnings still rose, right, by 10%. It was driven by mainly by gains, right? They had the Novena Square and Faber House divestments helped to lift the other non-interest income by around $200 million. And then also they had a GP write back, which is quite interesting, considering that they did that preemptive GP not too long ago. And also their wealth fees also grew by 29%, mainly from a higher invested AUM. So I think things are turning around a bit for UOB. We still maintain our neutral call, and then we don't change our target price as well at $43. So why do we say that? It's because they did actually lower their fee income guidance, right? And mainly because firstly, they said there's some investment banking deals that were pushed into second half. Those will come back, but the main negative is their card fees, right? Which makes up still a third of their gross fee income. They face 4 drags, right? This is the biggest issue, I guess, for UOB. It's the consumer shift into lower interchange categories. Also higher reward costs, which is a bit unavoidable in order to gain more customers. The higher Visa and MasterCard scheme fees, which were revised in June. So those were also unavoidable. And also some regulatory fee caps in selected markets. So with their expansion now, right, those will actually be very big headwinds. Yeah. And if you look at card fees alone, they were actually flat at year-on-year, despite them having around 5% growth in card billings. And for the NPA formation, right, the Greater China credit did worsen, right, mainly due to one mixed-use property asset in China, which was booked in Hong Kong. So not much more details were given about that. And the Greater China NPL did rise to 4.8%. And also NPA coverage there also fell. So that's a big worry now. They shifted from the US side now back to Greater China again. The main positive can take away from this is that they have ruled out another preemptive top-up. But then again, they give a caveat that they still expect at least another 2 years before the CRE, the commercial real estate property sector, recovers for them. So we could possibly see it worsening further. But the good news is they did give that 600+ million top-up in the third quarter last year. So I think that will be more than enough to cover a few of these NPL downgrades we could see maybe in the next 2 years. Yeah. One of the main another reason why also we are a bit cautious on UOB is because their guidance it does appear a bit stretched compared to what they are like showing now, right? Especially for their net interest margins, because they never changed their guidance, so they're expecting around 1.75% to 1.8% full year guidance for net interest margins. But in July, the exit was 1.71%, right? In first half, it was also 1.78%. So in order to land around that guidance, right, they need to average around 1.72% in the second half. But currently it's 1.71%, so it's still below. So I think that might be one of the main worries, and we'll see that pressure from the margins, in order to defend their net interest incomes. So we do have a neutral call, and also another reason why we have a neutral call is, as I said earlier, right, the July exit NIM is below their guidance. The Greater China NPA coverage has fallen, and also their ROE is also the lowest amongst the three banks. Yeah, that's for UOB. Yes, last one for me would be SGX. Yeah, next slide. So SGX, we titled it, cash equities have driven a record year, and indeed it has. Excuse me. Yeah, so if you notice, we did downgrade to neutral, right? Although we raised our target price to $25. Just to highlight that this is not a downgrade. This is a downgrade on the valuation, not on the business SGX has. We still think that SGX has a very good business, but the main reason why we downgrade is because they are currently trading at around 38 times earnings PE. If you look at the 5-year average, it's only around 22. And our target price is already based on the +2 standard deviation of that 5-year average, which is 32 times. And even then, we are only getting a target price of $25. And that's why we have a neutral call on SGX. So why is SGX so in that terms, so highly priced? It's because the market is really paying for what they're paying for is a record daily traded value, and then they are expecting that this will be the new normal moving forward, right? And we are, a little bit not very convinced on that part, because last year, you look at the 35% growth in the traded value, it came alongside very high volatility and also very high retail participation, which was at a 5-year high. And we don't believe that these two will really repeat together again, right? It's more of a one-off. But we still like the business. Why? Because the shift towards the cash equities is a good improvement, a genuine improvement. The main reason is because SGX charges cash equities on the value traded rather than per contract. So if the whole value moves up, then the revenue will rise as well with the market. And also about a third of it comes from the post-trade fees earned on holdings rather than on turnover. We believe there is some support ahead, mainly from the IPO pipeline, right? They are very positive on that. It's around 50 companies, and also the third tranche of the EQDP is expected very soon. So those are the two, tailwinds for SGX. But the main headwind would be the valuations. So at the current price, which is around 38 times PE, right, we are neutral. Yeah, and have a target price of $25. Yeah, okay, I think that's it for me. I'll now hand it over to Iqbal for AMD. Okay, maybe.
Hi, sorry, I'll present on behalf of Iqbal because Iqbal is in another result briefing. Yeah, next slide, please. So I'll start with AMD. So AMD adjusted PATMI grew over 250% in the second quarter to $2.8 billion, while the revenue rose slightly over 50% to $11.5 billion. So the second quarter result, PATMI, were at 43%, 41% of our financial 26 forecast. So moving to the positive, the data center revenue surged 107% year-on-year. This is the biggest year-on-year growth since in the third quarter of 24. So server CPU sales, which contribute 40% of data center revenue to cloud and enterprises, actually each grow more than 70% year-on-year. And we also do see adoption of MI 350 GPU continue to broaden across cloud provider and also sovereign AI deployment. So we still believe that AMD is still gaining server CPU from market share from Intel, whose data center and AI segment revenue increased 49% year-on-year. And AMD clients' revenue decelerate for the fifth consecutive quarter, with the revenue up 23% year-on-year to $3.1 billion. But we believe that it is also gaining the market share from Intel, because for Intel, the client segment revenue increased by 13% year-on-year in the second quarter, and we also continue to see a broader commercial PC adoption. So moving to the negative, so the second quarter gaming revenue declined 31% year-on-year. This is the first decline since the first quarter of 2025. We see gaming segment is now entering a cyclical downturn with the lower semi-custom sales, because the console hardware sales we currently see is reached maturity, and the gaming graphic demand was also impacted because of the higher component costs. For example, like memory costs actually drives higher graphic and graphic card prices. So for guidance, the AMD guided the server CPU sales to accelerate more than 80% year-on-year in the second half of the year. The data center revenue is guided to more than double year-on-year in financial year 2027. AMD also increased the CPU total addressable market guidance by nearly 2 times. It's guiding the server CPU market to grow to around like $220 billion by 2030. The data center AI accelerator market, including like both CPU and GPU, is guided to grow more than 45% annually to $1.4 trillion by 2030. The gaming segment is also expected to continue to decline double-digit year-on-year in the third quarter, because the company is still expecting the pressure from higher component costs and also a cyclical downturn. For our view, we believe that AMD data center growth will offset decline in the client and gaming segment. Is supported by a strong demand for Helios, which is expected to ramp through fourth quarter of this year and into financial year 2027. We also do see the hyperscaler increasing capex, which is up 97% year-on-year at the moment, and deployment of 2 gigawatts of MI4 450 GPU by Anthropic from the first half of 2027 could potentially generate estimate of $30 billion in addition revenue for AMD. So for AMD, we maintain a buy rating with a target price of $755, but we reduced the PATMI by 8% because of the weaker client and gaming demand, which we expect to enter the downturn because of the higher memory costs, like I mentioned it before. But for financial 2027, we increased the revenue and PATMI forecast by 4% each, because we do see the improving demand visibility for Helios and MI450 GPU, and also Venus server CPUs. And next slide, please. Yeah, so the next company presenting will be FRKN. The next slide, please. Yeah, thanks. So the first half of the revenue PATMI within our expectation is at 47%, 45% of our financial year 2026 forecast. So the PATMI declined 3% to $19.2 million. This is because there is a decline in semiconductor and also analytical science, life science revenue, but it's offset by the strength in medical, industrial, automation, and also automotive segment. So moving to a positive, the second quarter medical revenue accelerated 16% year-on-year. This is driven by there is a higher order in Europe for digital pathology equipment, and the second quarter industrial automation revenue also rebounded 19% year-on-year from the data storage customer. So for the second half of the year, the management guided the industrial automation revenue to decline because there will be changes in customer sourcing arrangement. And secondly, in the first half of 2026, the automotive revenue accelerated 10%. This is driven by a higher production of radar antennas, and the production ramp is expected to increase the Q-on-Q volume over the next 2 years, because FRKN EU automotive customer currently are training from pilot production in Sweden to high volume production in China. So for outlook, we do believe that in the second half of 2026, the growth in FRKN semiconductor, automotive, and medical segment would offset the guided decline in industrial automation segment. We think the DUV and metrology demand expected to surge for FRKN Netherlands customers, we see it potentially growing around like 44% and 32% year-on-year in revenue, respectively, in two half of 26, which is the third quarter and the fourth quarter. And our financial 27's revenue and PATMI forecasts are unchanged. So for Franklin, we upgrade to buy from accumulate with an unchanged target price of $3.30. Next slide, please. Thanks. So the next company will be Pan United. Next slide, please. So the PATMI was within our expectation, is growing for 52% year-on-year to $31.3 million. This is the biggest year-on-year growth since the second half of 2023. The revenue also accelerated 37% to around like $550 million. This is the biggest year-on-year increase since the second half of 2021. It's driven by 26% high year-on-year growth in ready-mix concrete volume, and also 9% increase in average selling price because of the supply constraint from the Middle East conflict. So the Pan United delivered a higher margin in the first half of 2026 because with the EBITDA and net margin expanding 82 and 55 basis point year-on-year, despite there's an estimated 9% increase in average selling price, like I mentioned it. The company managed to pass on the higher raw material costs to the customers. So there is the operational efficiency also from a higher delivery volume via the Air Digital Technology platform. It also supported the profitability, and the company also raised the interim dividend by 50% to 1.5 cents per share, with the dividend payout maintained at 34%. And the net cash remain healthy at $65.2 million. So we do expect the financial 26 for Pan United, the capex to decline 16% year-on-year to around like $40 million, following the higher spending in financial 25 because it to consolidate the batching plants in Jurong Port. So moving to the negative, for this quarter, depreciation expenses increases 36% year-on-year to $19 million. This is because there is a 20% year-on-year increase in financial 25 PPE. So despite the surge in depreciation, Pan United increased the net margin by 55 basis point because of the higher operational efficiency from the higher ready-mix concrete volume deliver. So in terms of outlook, we think Singapore construction sector remain pretty robust because the first half progress payment is rising 40% year-on-year to $22.5 billion. This is supported by major infrastructure, healthcare, and also BTO projects. The construction visibility also remains pretty healthy. The first half of 26, the contract awarded up 9% year-on-year to $31 billion. This is driven by a strong industrial project tenders. And therefore for Pan United, we maintain a buy rating. And at the same time, we also increase our TP to $1.96 from $1.73. And we also increase the revenue by 17% and PATMI by 9% because on the higher RMC prices and volume from the major project progresses. Yeah. And moving on to next slide, which is the last company, which is Centurion. Next slide, please. So the earning were within our expectation. The first half revenue accelerated 31% year-on-year to $185 million. This is the biggest year-on-year growth since the first half of 22. This is driven by the recent acquisition and also asset enhancement initiative. And the adjusted PATMI declined 16% year-on-year to $48.8 million because of the almost 2 times year-on-year higher profit to non-controlling interest of $26.6 million. Followed by the car REIT spin-off. So the Centurions secure a 3-year lease extension for the more than 1,200 bed West Leeds Tuas Avenue 2 dormitory with an option for a further 3.5 years. So we believe the extension reflects a tight worker dormitory supply in Singapore. This is also supported by the ongoing major construction projects. So for the negative, we see the net gearing increased 12 basis point to 24%. This is mainly due to the higher borrowings to fund the additionals and enhancement to investment properties. So despite the increase, we view the leverage at the moment as healthy and below the historical average of 33.8%. For guidance, the company guided the second half of 26 revenue of $190 million, with the total BET expected to grow at a 5% by financial year 28. The growth will be driven by Singapore PBWA and also Australia UK PBSA and also Australia KWA. Is alongside potential wins from the upcoming Singapore dormitory tenders. We also believe there is a strong construction activities in and also the first half progress payment growth of 14% year-on-year. Like I mentioned it to continue tight worker dormitory supply and also healthy demand. So for Centurion, we maintain the buy and we increase our target price from $1. So we increase our target price to $1.94 from $1.85. We do expect the potential renewal of Centurion's remaining QBD bets in order to provide a further upside from the sustained construction related labor demand. Yeah. And that's all from me. I'll pass the time to the next presenter, I guess. Thanks.
Yeah, thanks, Serena. I'll move on to the technicals. So next one is that looking at S&P 500, I think now is still forming a new all-time price. In terms of the technicals, price action has been holding support along the 5-day simple moving average, which is the blue line that you see in the chart, and then the Bollinger Bands are also expanding upwards as well. So yeah, recent price action is a bit of a bullish flag. I think we're still likely to see higher price going ahead. Near-term resistance wise could be at 7,815 to about 7,870 area. And then in terms of the current support, it's likely to be at the 7,715 to about 7,770 area, which was like the range lows last week, as well as where the 10 days average the red line is. Yeah, so that's all from me. Yeah, so I think Paul is currently in another meeting, so we'll skip his slides for now, and then we'll move straight to Q&A. Thank you.
I guess I'll get the ball rolling. So there was a question about who is Walt Disney's main competitor. Well, it's a little bit complicated for Disney's service. So they were in the film and TV studio and also the parks. So the direct competitor would be Universal, Warner Brothers, Discovery, Paramount, and Sony. They're also in the streaming business, but they joined the streaming business a little bit later. Previously, they were in the cable service, but because of the cord cutting, and they realized that the previous cable service is no longer survivable, so they're trying to expand into the streaming business. So their competitors are like Netflix, Prime Video, Warner Brothers. But when it comes to streaming, Netflix is still the clear leader in the streaming industry, so they're able to monetize almost twice as better when you compare it to Disney. But I guess the Disney's advantage is their user base is a little bit different. So for Netflix, the users are usually whatever popular movie or series, people go onto Netflix to watch. But Disney has more of like a very loyal fan base. So imagine you have a kid, so you're probably going to be playing the Disney movie like 10 times a day. So it's a little bit a different target group. Disney is also in the sports streaming business, so it also came from the cable service. But then because no people watch sports on cables anymore, so they're trying to launch it into streaming online. So their competitors was Fox, NBC Sports, and also the other platform that also do live screening of sports like YouTube or Amazon. On Netflix also does that. So a little bit different, but if you say direct competitor, I would say Disney is one of its kind. Like I mentioned earlier, the way they function is a little bit different from all the other competitors. They're a little bit in everything, and all their segments are kind of correlated. So whatever that happened in the TV, the film industry is able to resonate and also help to push their parks and their customer products. So it's really a very unique positioning company. So yeah, I hope that answers your question. Grab has been trading at $3.6 for the long time, but the target price is $7. Any reason? That is the exact question that I keep asking myself. So back then when we initiated Grab, the price was about $5, and we like the company. We think there's tremendous growth prospects, which is why we initiated with a target price of $7. But then over the years, every time we release earnings, there's never any negative news. Like, yeah, sometimes they have some regulatory issue or they have the fuel price went up, but we're always seeing a very, very strong demand and the growth is always accelerating. So there's nothing bad enough for us to revise the target price down. I think Grab itself, they're also very confident in their current pricing, so which is why they're always initiating buyback. So we think nothing wrong with Grab. The reason we initiated Grab was because previously we covered Sea Limited. So we think both companies, they're a little bit similar in a way that they are the clear leader in the Southeast Asia. They're good at what they're doing and they're trying to take advantage of their very large ecosystem and loyal customers, and they're trying to take advantage of the data that they're able to collect, and then they're trying to slowly expand it into finance, try to make their app like a super app. And this will work because in the Southeast Asia, it's a lot of people are underbanked. So we think the trajectory is a little bit similar, but I think what Grab is different from Sea Limited is Grab, their finance segment just roll out not for very long. So currently it's just happened to break even and they're targeting for a profit in the second half of this year. So it's still in a very early stage. So maybe that's why the market is punishing them a little bit. And another reason is maybe that the market believes Grab is not gonna be able to lean onto the data as much as Shopee could, because Shopee, the data they have is your household purchase. So that's essentially a whole lot more data when you compare to Grab, because Grab's data that they collect is basically how much I pay for taxi. So it's less extensive data when you compare to an e-commerce company. So that could also be why. But like I said, Grab right now, they're trying to grow their Grab Mart service as well. So that could be something that they're slowly trying to fill in. Yeah, but so we're still very positive in the long term. Yeah, I hope that answers your question. I think there was another question just now. How does, I guess you mean Shopify, monetize its catalog? Okay, so let me explain a little bit more about catalog. So catalog is more like, it's not a customer-facing website. You can think of it more like a database. So for whatever merchant that's using Shopify to power their e-commerce website, Shopify is actually taking down the data of the product that you're trying to sell online, and they put it in such a database that they neatly organized. So everything was packed very neatly. And then even if you're not using their merchant website, so let's say you're a seller on Amazon, you can also choose to talk to Shopify and say, oh, I want my product to be included on the tech catalog. So they will do that for you. And what this helps Shopify is now there's a lot of agentic AI. So let's say I want to search for a product. So previously the traditional search is it's by keyword. So if I wanted to buy a black bag, so the keyword is probably only bag or black. And so there's not much I can play around, but now with the AI, I can put in a lot more unique requests. So I wanted a bag that's a black bag, but I also want it to be under 200 US dollar, and I want it to be so I can add in a lot of extra details. So of course the AI, it's powerful enough, it's able to pull the data from all different kind of website, a different shopping website to compare and everything and come up with a list of the result. But what catalog does is it's already organized in such a neat way and down to the very nice details. So it would be like an existing database that would be super easy for AI to just get the information from. So like Shopify, like they shared, if you use catalog to find something, you can find it twice as fast than you opening multiple website and compare it yourself. So they don't directly monetize from this, but what it does is they will allow AI to frequently use their website, so more people will be one to include on their catalog. And because of most of the product that's containing on the catalog actually comes from the website that they're helping their merchants to power the Shopify website. So it will lead a lot of direct traffic from agentic AI to their merchants' website, which is eventually going to lead to GMV growth. So this is sort of like an indirect way for them to monetize. So I don't know whether this analogy is suitable, but you can think of it as in the old times when you're trying to look up for somebody's phone number, you always go to those yellow page phone directory, and you can find pretty much all the things there. Of course, you can try to find the phone number from other sources, but then it's pieces here and pieces there, and some of the website might not be updated. So it's just not as easy to get information compared to you directly looking into that. So of course, AI, they're able to pull everything, but then they will increasingly find that pulling data from catalog is a whole lot easier, and they will try to use it more. So I hope that clears your understanding a little bit. Yeah, I think that's all from me. I'll pass my time to my colleagues. Thanks.
Thanks, Helena. Yeah, let me just go through some of the questions. Quite a few questions for me. Sorry, let me find the first one. Apologies, I can't find it. Yeah, okay. So CK asked, with management at DBS saying FY26 performance will exceed 25 and ROE remaining strong, 17.5%. Do you think DBS will increase its dividend payout by 6 cents per quarter starting from fourth quarter of this year, as per the trend in the last 2 years? Yes. Even our forecast actually does include that 24 cents per year increase. And this is in their base dividend. So just keep in mind that once they increase this, I think they will continue to keep it at that level. So look at our $3.30 and even our $3.54 dividend, that includes that 24 cents, right? Or 6 cents per quarter. Yeah. So we are expecting them to continue. Yeah. Mainly for the reasons you have also mentioned, that performance is good, ROE is strong, right? And they're not even spending 100% of their dividend. Yeah, it's not even at like maybe 70-80% of their payout ratio. So they still have some room. They are still accumulating capital even at these high payout levels. Yeah. So I believe that they can and they will pay back that 6 cents. Yeah, I mean, it's a bit like you give someone, you keep going. I mean, funny analogy, but like if you go to eat, like, in a coffee shop and they always give you extra rice for free, and then suddenly one day they just say no extra rice, you also be very disappointed. Yeah, a bit of a silly analogy, but that's how I look at it. Yeah, so I believe that they will still give, especially since they're doing so well, right? Yeah. At least for the next quarter, yeah. So at least for this year, they will highly likely that they will give that 24 cents. Yeah, okay, I think Ziyi is answering the one about the rates. Okay, one more from CK. In terms of share price performance between DBS and OCBC till year to date now, OCBC's performance is better. Will this good performance keep propelling OCBC for the rest of FY26 and into FY27? Good question. So if you look at OCBC, yeah, it is up about 52% year to date against DBS is only around 37-40%. So yes, it has done better, but you must also look back the previous year, right, where DBS did better than OCBC in FY25 or even FY24. Right? But now I think the OCBC, is sort of recovering a bit better, or is performing a bit better as well, because DBS might be a little bit too expensive for some people, especially if you look at their price to book, their PE, although they are offering much higher ROE. So that's the difference. The main reason why OCBC is performing better is really of that ROE. It's a lower ROE. You're comparing 14% versus close to 19% kind of ROE, at least in our forecast. So that's why we believe that DBS still is so much higher price, and also why they are keeping up in pace, although it is much more expensive. Yeah, and even for dividends wise, right, it's quite a big difference as well. Looking at 4.3% for DBS versus OCBC is only around 3.6%. Yeah, and even for OCBC, there isn't really much upside on dividends because they are still maintaining their 50% payout ratio. The only thing that we can look forward to is maybe end of the year they will give that special dividend because they couldn't buy back shares because their share price is too high. Yeah, so that might be the only thing we can look forward to in terms of dividends, especially if you are you need that, you are looking at dividend, right, for banks. I think DBS still stronger. Any impact from sorry. Yes. Yeah, sorry, one more here. Will there be any market correction from the US come the US midterm? There might be a lot more volatility, right? But I don't think so. The main things, if you look at, I think the main thing, maybe correction, but it won't be, just be a small one, I guess, if anything. And the main things that will move the needle will be the interest rates and earnings. Those two things are way more important than just US midterm election. Although yes, it's important, but I think in terms of market correction, I think interest rates and earnings are things that we will a bit more fundamental, more things to base on. Yeah, any impacts on the bank's bottom line from the Chenzhi scam fallout in Singapore? Not sure this scam, but I don't think there will be much. Even if you look at the previous one, right, the most recent one or 2 years ago, where they had like a few $1 billion worth of scams, and all the banks were basically actually involved in it. The fines that MAS gave only was across the 9 institutions, the 9 banking institutions, was only under $30 million. In comparison, you look at how much DBS made, right, in terms of profits. First half of the year was 6 billion. So I doubt there will be any impact, right? Even if they fine them 100 million or so, it's just a little dent, like just one grain of sand in the sea, right? Yeah, so I don't think there will be any impact. If anything, it will just come as bad debt, right? Or some loan, or some small uptick in NPLs, because it's still relatively small in terms of, like, you look at UOB, right, with their CRE, I think that will impact a bank a lot more than just like this scam. Because even this scam ones, like you look at the GCB or some of the cars or whatever that was financed in the previous scam, right? They also, I think, managed to sell it off in eventually, right? It took a long time, but I think they still managed to sell it off and recover some of the assets. Yeah, and property price in Singapore doesn't fall much. Yeah, but whereas in Greater China especially, or even in the US, right, the office CRE prices can collapse, and you can see that in terms of UOB. Yeah, I think the main cost for the banks will be like time and compliance. Yeah, and also a lot more scrutiny from MAS. That's the one that will really hit the banks. Like that's why MAS don't find them money, right? They find them with the capital cap, right? Their CT cap, which is what they did with DBS. I think that one hurt them a lot more than any kind of fine that they can give. Yeah, I'll answer this for Paul. Is asking, do you foresee UOB selling UOB Kay Hian like they did UOB AM asset management? Highly unlikely. There's no sign of it. And it's also a very different situation. You must look at the two things. It's like comparing an apple to an orange. UOB AM is fully owned and wholly owned by UOB, right? UOB, the bank, the group. Whereas, and also for fund management side, they do need to scale in order to earn a decent amount. So they rather just distribute the products than to manufacturers own, right? It's a lot easier, and I think a lot less cost for them. Whereas you look at UOB Kay Hian, it's actually separately listed, and UOB only, like UOB Bank, the group, only holds a minority stake, right? If I'm not wrong, I think KN is run by one of the Wee. It's also run by the Wee family, but one of the brothers. Yeah, so it's not for UOB Bank to say to sell it because they don't. It's not like UOB AM where they own it fully and they can just dispose of it or divest it. Yeah, so I don't think they will do that. Don't think they will, and I don't think they can as well. Not so easily. Yeah, a few more here from Ian, asking, with Singapore banks at historical high, do you think there will be any share splits anytime soon to make it more affordable, or the further reduction in lot sizes will suffice to increase retail participation? Yeah, I don't think there'll be any share splits. It has been asked previously as well whether there'll be any stock splits, and I think all the bank's management said no, there's no need to do it. Yeah, even if you look at the current 100 share lot, DBS is, you need about $7,600 to buy DBS, and that's the most expensive. And then you're looking at UOB is 4,000 plus, and then OCBC around 3,000. So they're going to cut that bot lot, right? If it goes down to 10 or even 1, right? You're looking at $760. Yeah. So I don't believe that they will need to further do another share split, yeah, in order to make it more affordable. If anything, right, if you look at what DBS and UOB are doing, they're buying back shares, which actually shrinks their share count. So it's an opposite of a share split. Yeah. But I doubt they'll do it. No, now SGX is stepping in to help them, so they don't need to do anything. Yeah. And I think it's more straightforward as well, if you do a reduction in lot size rather than do a share split. Okay, I think last one for me from Ian again. Will earnings of SGX be negatively impacted with aim to encourage the transfer of CDP cash holding on Singapore stocks to local brokerages instead? No, not much, and I don't think anything, maybe possibly really nothing at all, because 60% of their cash equities is revenue, or the revenue is the clearing fee, right, which is charged on the value traded. So where the shares are custodied or where the shares are placed at does not change that. The main thing is the settlement, depository, and corporate actions. So it's still very small, right? It's only around 12% of their group revenue, and also that is mostly charged per transaction rather than per account. So the shares don't really leave the CDP, right? So they are holding them for you. Yeah. And the settlement actually still runs through SGX. Yeah, I doubt that there will be any impact. I don't think they will do it if there's an impact to their bottom line. I think I answered most of them. Yeah, let me pass it on to the rest if they have anything to answer, or if nothing, then maybe we can hand it back to Zane for the TA. Thanks.
Okay, thanks, Glenn. I think I can take over for the TA. So let me just try to share my screen. Yeah, so first question I see is on CNMC Gold Mine. Yeah, so for CNMC, in terms of the chart, I think currently after the results, seeing a bit of a gap down today, and then price is holding around the 10 SMA level, about 138, about there. Yeah, on the weekly time frame, I think overall it's still turning up pretty okay. I think the general support on the weekly is about 135, which is the 5 SMA level, which could see some pullback from continuing from last week. But I think generally like 133 to 135, I think there should be some support with, given that 133 is also this previous horizontal level over here, closer to 20 MA. So I think probably we'll see some pullback and then some sideways consolidation. And then currently resistance about 143 and above to the about 148, which was the highest last week. Yeah, so I think will be likely some sideways. Yeah, they also see a question by Eugene. Yeah, there's a USTA session tonight that's taking place at 8 to 9:15. Yeah. Okay, then next question on Semcorp Industries. Yeah, so for Semcorp, I think overall it's still, yeah, in general, still a bit of a downtrend taking place. In terms of the weekly chart, I think the strong resistance, I think somewhere close to about $6 or there, where we have the 20 SME weekly. So some positive things that for now, price has crossed the 10 SME weekly about 579. So some about 3 weeks of rebound. So for now, I think we might see some support around the 570s area, given that it's also like this swing high has been broken above on Friday, where there's also a 10 SME level of 574. So I think some pullback, I think that would be a bit of a support. And then resistance general on 6. Strong resistance. The next one on Hong Kong land. So yeah, for Hong Kong land, in terms of the price trend, I think it's still trending pretty well. I think overall, price has been a trend. The strong resistance area is about 870 to about 890, and then the price also on Friday broke out this resistance at 840, where there were a couple of upper weeks previously. Yeah, so I think overall we might see continued momentum. I think to test about like 870 to about to about 890, then we see some pullback afterwards. But I think generally price will be well supported above like 845, which is currently the 5 SMA level. The next one on some US counters on first one on Broadcom. Yeah, so for Broadcom, I think generally price was kind of ranging at about $413 and then holding the 10 SMA level as well. But on Friday there was a sell down on higher volume as well. Filled this gap over here about 392, 393. So I think it's really quite important for price to go over here. Short-term resistance wise, I think would be likely above 400 to about 407 about that. There's a bit of rebound. Yeah, so on the weekly time frame, I think also quite important to hold Friday lows, given that a couple of moving averages on the weekly are over here as well, 5, 10, and 20 levels. Yeah, so it's yeah, so probably we could see some slight rebound, but I think generally will be facing quite a strong resistance for now at like 407 about that. Yeah, then the next key support, I think below, if there's a breakdown, I think the next key support will be somewhere close to about 375. Yeah, which was like the recent lows at the end of July. Okay, next on Apple. I think Apple generally just kind of like a bit range bound for now. So I think 300 is quite it's like a support that's been tested about twice, 300 to 301 level. Generally still a bit of a lower high bounce for now. Resistance I think looks like from the 10 SMA level daily or around 307. I think we might continue to see some weakness. Given that price, I think at 309 and 310 over here at the start of August, there was price failed to hold above this level. So there's, I think, generally still resistance above 307 to 309 about there. So I think we could see some kind of range bound consolidation right now. And then in terms of weekly chart, the next key support, I think that will hold the price to be tested is the 20 SMA weekly. So previously when price retraced this level end of June, I think price did rebound over there after the retracement from the highs. And so I think that could be a level to look at, the weekly 20 SMA, which is currently 297. The next one on Nvidia. So Nvidia, I think after the gap up on 5th August over here, I think January has been quite positive. So the gap up is above a key area of resistance at 213 over here, which previously price traded in the range under. So this kind of looks like a um, double bottom as well at 192, and then given now that price had broken out of 212, 213. So I think overall still quite kind of inching higher for now. Generally price is finding support on the 5 SMA daily. So I think overall for now support is likely to be at 222 to 223 this area for now. Then in terms of resistance, I think could go on to test the highs around 232 and above. So 232, I think currently is around the daily upper Bollinger Band level as well. So overall, Nvidia, I think still looks pretty strong as of now in terms of the current momentum. As long as it doesn't break down below like 222 and so and then I think we could see price trying to go higher to test about 232, the next key resistance. The next one on J&J, Johnson & Johnson. Yeah, so for Johnson & Johnson, I think generally it's kind of a uptrend counter and a bit of a range bound price action recently. So I think one support level is probably this our trend line support over here that's been holding the price of forming higher lows. And then price tested is 269, 270 resistance twice. So for now, price action kind of just like restarting too much on the daily. On the weekly, I think it's more defined. On the weekly time frame, you can see price is generally holding the test and weekly. This red line around 253, 254 is this week's support. So I think as long as it doesn't break below that, I think we should still see a good trend upwards for J&J. Then next one on TSM. Yeah, so for TSM, I think generally kind of follows the semicon rebound recently as well. Now price is above this key level of 420 level over here. It was previously this swing low support breakdown area, and it turned to resistance over here, 22nd July as well as 31st July over here. Then price managed to hold steady around here. So I think as long as 419, 420 here holds, I think that should be still positive. Where it's also the 10 SMA level as well. Then also currently we could still see price try to go higher to test double Bollinger Band levels. 436 was the swing high on last Thursday, and currently about 439 up Bollinger Band levels. Yeah, so that's for some of the US counters. I'll move back to the other questions. Let's see. Okay, I think there's a question on may I know when IS Biopharma, what price is a good buy, and then any target price. And so IS Biopharma is still in an uptrend, and then the good thing is that recently it also broke out this 29 July, so broke out this consolidation. So that's a positive development. So in terms of price action, I think could be quite similar to what we've seen on 30th April over here. So looks kind of similar where price currently doing a pullback from the highs, and then we might retest this swing low USD, and then we like to see a bit of rebound and sideways again. So I think for now, in terms of good price to buy might be like closer to 49 cents this area. So that's a swing low 30th July and then 20 SMA level. In terms of the weekly, price could be doing a retest of the 5 SMA weekly as well, 496. So I think overall close to 490 level might be a good price to buy in the short term or in terms of IS Biopharma, given that price has pulled back quite a bit from the highs. Yeah, in terms of target price, I think Paul has a target price of $1. And this question is PC Partners. Yeah, in terms of PC Partner, I think overall generally is still a very strong trend counter, and then after the today there's a bit of a pullback from the highs, and then I think generally we could see price find support for now is about the 301 to about 304 this area over here, given that this was a range resistance back in the middle of August, and then currently that 302 is about the 10 SMA daily level as well. So I think price test this level, we're likely to see a bit of a bounce coming. Yeah. Also currently yeah, just some pulling back from the upper Bollinger Band level today about 325. Okay, next one on Venture Corp. Yeah, so for Venture, I think after the results, I think in terms of the price action, it looks good, given that price was pulling back from the highs from since 7 May, and then recently kind of just range over here between like 1570 to 1640. And after the results, I think there was a big gap up over here. And then subsequently, but now we are seeing like flag being formed, price moving sideways. So I think as long as it can maintain at least the 10 SMA, which is like 1670, like near close to the opening price of this gap up candle over here, I think it's generally still positive for Venture in the short term. Yeah, to see a retest of the resistance over here recently about 1740, 1750, about that. Okay, the next question on Singtel and BYD. Yeah, for Singtel, I think generally what we're seeing is like a kind of range bound taking place. So I think price action wise, previously like end of July it was pullback from the upper Bollinger Band level, then all the way went to the lower band, like recently last week, 422, and then we're seeing a sort of huge spike on Friday. So I think currently, I think price will just kind of maintain within this big broad range between like about 422 to about 450, about there, just straight sideways for now. And this one for BYD. Yeah, in terms of the chart, I think BYD kind of still range bound for now. Pulling back, there was a bit of a pullback from the in terms of the Bollinger Band, it's kind of flat, so it's like generally between a range of 86 to 95. In terms of recent price action, there was a bit of pullback from the after testing the swing high at 96. But it's at least still holding around this key swing low level of 87 over here. So this 86, 87 level quite important to hold, given that this was a range breakout level and then swing low being formed. So I think price action wise still kind of just range bound for now. Then yeah, some resistance recently about 90.6 over here. If you can overcome that, we could see a test back towards like 92.6 and above here. Okay, then there's a question, are you able to comment on Olam using PA? So let's take a look. So Olam, yeah, generally has been on an uptrend like since March this year, and then in terms of the price action, it kept down after the earnings. But I think we are likely to see some sort of rebound, at least in the short term, given that it's like support is holding at near the lower Bollinger Band levels. Like this was about close to 120. Then on the horizontal time frame, horizontal levels like 117 to 120 over here. There's also a horizontal level. So price is doing a bit of a bounce past like these 2 days. In terms of short-term resistance, we could see some temporary resistance like 120, close to 128. That will be a retest of the 5 SMA level, and then kind of close out the gap. So 128, 129 first resistance level. And then afterwards, like 131 will also be another resistance. Yeah, so I think short term wise, we likely see a bit of bounce, and then does fill the gap, then maybe some pullback again, then do a bit of range trade for Olam in the short. I'll pick like two more on SIA and Capital. Yeah, so first one for SIA, I think generally yeah, we could see some weakness. I think going ahead, given that price was originally in this range over here, like 720 to 750, and then looks like there was a like breakdown over here with high volume as well. Bollinger Band is also opening up to the downside as well. So for now, it's still holding on to like $7 this level. So this is a key support level to hold. Yeah, if it goes below that, we are likely to see some lower levels being tested. That will be around 690, and then next one is like 680. In terms of resistance, for now, it's about 710, and then 720 is a strong resistance. So for SIA, we might see some continued weakness outwards, especially if $7 is being pushed. Then what I'll do is Capital. Yeah, so for Capital, I think generally it's still within this this rising channel formation that was formed since middle of May over here, with support is still holding at these key levels, like that's around the $11 level, with a horizontal support as well as a channel support. So for now, we're unlikely to see, I think, some sort of a range bound resistance about 1150 onwards, about 1160 right now in terms of short-term resistance. And we might see some range bound. So it's quite important that 11 is holding. If not, we might see some, if not, there will be a breakdown of two levels of support for Capital. But for now, I think still looks okay, kind of range bound. Yeah, so I think that's all for me for the TA. Yeah, so since we're here about the 1 o'clock mark, I think like we'll just end our session here today. I'd like to thank everyone on behalf of my team for joining and also for all your questions. This week, in terms of the corporate insight webinars, we have a few. We have I think three corporate insights webinars taking place this week. So if you are free, feel free to join. And also hope to see you again in our weekly call next week. Yeah. Thank you and have a good week, everyone. Bye bye.